Hello and welcome to the Mindmeld Live. I'm Cairo, Community and Marketing at Shell Protocol, and we are very happy to have you tuning in either live or recorded, wherever in the world you may be. We've got another technical big brain on our podcast today, so once again, I'm going to be handing it over to Kenny to do the introductions and the lion's share of the interview. But I will be around and reading your questions. So please, if you have them, go to the Mindmeld chat channel on our Shell Discord and type your questions. And if pretty much no matter what they are, we will address them uh, with few exceptions. So, Kenny, I hand it over to you.
Awesome. Thank you, Cairo. Well, today we have a really special, interesting guest, especially if you're into economics and finance. It's Guillaume Lambert. He is, slash soon to be was, an assistant professor of applied engineering physics at Cornell University with an expertise in single cell microfluidics, antibiotic resistance, and synthetic biology. But more germanely to our discussion today, he is also the founder of Panoptic, a perpetual Oracle-free options protocol. I've been following Panoptic and Guillaume, your work on options and DeFi for a while now. I'm really excited to get to learn about it like firsthand from you. But before we dive into discussing Panoptic and options and DeFi, I think first it'd be really cool to learn a bit more about you and like what attracted you to DeFi. Like, how do you go from being like a physics and biology professor to designing an options protocol? Yeah, what was that journey like?
Yeah, of course. Hey, Kenny. Yeah, thanks very much for inviting me. Yeah, I mean, we can go even back further. So again, I have a training in physics. I followed the academic route of doing it, undergrad, PhD, postdoc. Even before that, I grew up on a farm. So actually, I'm coming from a very humble beginning. I just wanted to travel, wanted to study, wanted to do the coolest thing I could. Back then, it was physics. During my PhD, it was biophysics, which was kind of a new way. Oh, you're looking to learn about physics. You think you know everything. Now learn about life. You know nothing in that case. So just going through very, very like common postdoc faculty position. And again, I was generally interested in anything in science, anything in technology. And again, I knew about Bitcoin, but maybe it didn't catch my attention as much as when I first learned about Ethereum. Again, Bitcoin is fine, digital gold, there's not much to do with it. With Ethereum, it was clear to me you could do a lot more. Like you can program smart contracts to do, again, what we now see it can be done. So I was kind of early on very interested in DeFi, very among the first users of MakerDAO, Uniswap V1. I was deploying pools in Uni V1 as well, V2 of course. And then again, I got liquidated on my MakerDAO CDP early on during the 2018 bear market. Overall, I didn't quite know like what to do with it, but just playing around was kind of fun and to me. And so when Uniswap V3 launched, I was excited because it seemed very, very new, novel. You can concentrate your liquidity. And it's after the first few tries, I realized that I got wrecked. I lost money without really understanding why. So I just decided to sit down, pen and paper in hand, try to derive, okay, what's Uniswap? What's the equations? What's the models? What's the model behind it? And the more I dig, the more it helped me, I guess, in my playing. And then also it allowed me to kind of discover what Uniswap is. It's a option-like product. When you LP, you create an option, and then that's kind of the starting point. But moving, again, this is kind of what I'm going to be doing. As you mentioned, I'm an assistant professor in applied physics. I'm kind of leaving it all behind to be the full-time founder of Panoptic. At the end, I feel like this is kind of tapping in a new way. There's a sense of, yes, discovery, the new frontier that, again, you can find in science, of course, but now this is kind of maybe right place, right time where I could also kind of have an impact. So that's kind of be my second phase, perhaps, of my career after the academic one, just be a full-time founder.
Well, for one, I'm really stoked and excited to have you full time in DeFi. We need to attract brilliant minds to this space, and it's great to see that the sales pitch is working. I definitely can relate to your experience with like Bitcoin versus Ethereum. When I heard about Bitcoin, I thought it was cool, but like it wasn't until I learned about Ethereum that I really like, oh wow, this is like really like a big new technological paradigm shift, and there's a lot of really cool things that you can build with this, and we don't really know what they are yet. And
Exactly.
I guess one question we like to ask all our guests, which is like, how often do you personally use Web3, and like, what do you use it for? Obviously, no, don't share details you don't want getting being public out on the internet, but just out of curiosity.
Yeah, of course. And then maybe I almost doxed myself the other way, but no, the key point is that I enjoy it. Again, I have managed hundreds of positions in UniV3 over the past 2 years. I'm kind of the top 50 holder of NFT. It's at the retail level, nothing to break the bank, but just my kind of play money. And again, daily. For a while, I was kind of figuring out how to do it. I latched on a set of strategies that worked pretty well for me. It involved borrowing assets on order finance and then locking it with my own ETH. I was happy. It was working well. I could do it with Shiba Inu, all of this long tail of assets. Of course, order finance got hacked. So it calmed down for a little bit. So now I have to go on Aave and Compound with a little bit more boring pairs. But yes, very daily. Again, trading in Uniswap v3 is very options-like, but you don't have to be in front of your computer 24/7. It's not a perp trading. It's not like even swing trading. It's somewhat passive. You set up a position, you wait a few days, maybe you need to adjust, maybe not, but it's not as you don't have to be kind of on top of it all the time. So in my case, every day I log in, I look my positions for like 15, 20 minutes. Maybe I adjust. If it's the gas too high, I wait a few hours. But it's, daily, I guess. I still do it daily.
Nice. Yeah, you're, believe it or not, one of the few people that I think are like DeFi power users we've had on. Like a lot of people work full time in the space, but like they don't use it every day. I'm guilty.
Yeah,
I
I
don't
think
use
that's the most common story that we've heard, certainly.
I mean, I'm
yeah,
building Panoptic because I want to trade options. This is kind of missing piece in the whole ecosystem. We have lending,
Yeah.
we have spot, we have yield, I guess. But yeah, options. Get right. I'll be the first user. I'll be the last one probably. It's like, I'll be a power user even with Panoptic in mind, of course.
Yeah,
Guillaume,
we're building.
your connection is a little spotty. I don't know if you've got anything you could close or
Yeah, so sorry about that. I think let me cycle through.
no worries.
Yeah. Nope, not
It was
Chrome.
okay, and then all of a sudden it
Yeah,
happens.
yeah, of course. And I think the is it better? I see that you are kind of a blurry, Caro. I don't know if
It's okay for me. I guess some of the viewers are saying it's a little distorted, but there's only so much we can do. Guys, if you're having trouble watching the stream, you can always watch it on replay, and the quality will be much higher on the recorded version.
all right. Sorry about that.
Anyway, sorry. Back to what you were saying.
So, I think let's sort of transition to learning more about Panoptic. But before we get into like the meat and potatoes of the protocol itself, I think it might be helpful to get some background about options, both TradFi and DeFi, just so we have some context. And before we even get to the context, maybe if you could give us like a TLDR about like what is Panoptic and why is it a big deal?
Yeah, sure. So I'll tie it with options in general. Options are extremely useful in TradFi. They serve a specific role that you cannot really kind of do without. It's a hedging mechanism, risk management. It's not a futures, it's not spot trading, it's not yield. It's just a different way of investing. And on its own, again, institutions have known about this for the past decades. That's why there's so much volume. It's a very necessary instrument. And again, in terms of if you want to do lending on chain, you can do it. If you want to do spot trading on chain, you have that. You can do staking, but options is not something that you can do at a scale that works within the confines, say, of the blockchain. And what we're doing with Panoptic is that we're creating an options protocol that I like to call the Uniswap of options, meaning that you can trade options on any asset at any strike, and there's no expiry. It makes it very easy to manage in a way that's kind of very DeFi native. It's like if I were to explain to you Uniswap in 2015, you would say wait, I don't get it. It's only when you trade for the first time that it's almost magical. Say, oh, I got some ETH for my USDC. Fantastic. It's the same thing with Panoptic. We feel like we're going to be kind of bridging the gap between TradFi options, which are extremely difficult and perhaps obfuscated because they are complex, and what you have kind of in DeFi, where it should be a little bit more useful. So the TLDR is that we're offering options on any asset. Anyone can buy, anyone can sell in a way that's very, very decentralized.
Sweet. You got me pumped.
Yeah.
Okay. So I guess what was the inspiration for the name Panoptic?
Yeah, so the Panoptic means it's all encompassing. You see everything at once. It's like you have a broad vision of the whole thing. And the key point is that in Panoptic, if we want to contrast this with TradFi, is that everything happens in the same smart contract. All strikes, all expiries, all the liquidity can be kind of visualized in a single smart contract. That smart contract happens to be a Uniswap v3 pool. And that's kind of a weird link, but we can execute options trade in the Uniswap pool, not just by swapping, but rather by providing liquidity. But it's very, very self-contained. You don't have liquidity fragmentation. You don't have different timelines. It's all in one spot. So I mean, for this as well, there's optic in there. I like the turn, but overall, yeah, it's seeing all at once is what kind of we want to capture with the Panoptic name.
Yeah, certainly transparency in financial markets is, thoroughly desirable, especially in something as complex as like options. So, I guess, could you sort of briefly explain, like, how does a basic TradFi option work? Like, what is a put, what is a call, and implicitly, like, what bet is a trader making when they like buy or sell like a vanilla option like that?
Yeah, and I always approach this maybe a bit differently, because the I think the way that options are introduced is a bit misleading. You can buy options, and this gives you the right to sell an asset or buy an asset, but the core like transaction is that you're just trading a specific payoff. And if you buy a stock, it's up to the right. The price goes up by $1, you make $1. It goes up by $1, you lose $1. If it's shorting, you invert this. But at the end of the day, it's all kind of trading this asset, this payoff. And it's a bit more visual, but when you trade a put option, buy or sell, or a call option, you should not think about, oh, it gives me the right to do XYZ in the future. You're just trading a specific exposure. And the exposure of a put is a little bit like a short position. Exposure of a call is a bit like a long position. But and you pay for it, you get paid if you sell. There's a few intricacies, but it's just a new way of looking at what you're trading. And in Panoptic, that's why I reframe it, because there's no expiry. A lot of the options lingo is that by the expiry, you can do XYZ. In Panoptic, it has no expiry. So it's counterproductive to discuss of like the right to buy or sell, because it never ends. It's just better to think of it in terms of like payoffs you buy. You buy a upside positive delta payoff. That's a call option. You buy a downside protection negative delta payoff. That's a put option.
Let me see if I can paraphrase what you're saying, because I think this is like a really good way to look at it, where buying or trading any kind of financial asset, you can think of it as you create like a relationship between a price of one asset and the value of, some other asset, your portfolio, or just some other asset you hold. When you just buy and hold like a regular like Bitcoin or ETH, that graph looks like basically every time like ETH goes up $1, you hold one ETH, the value of your like portfolio or your position goes up $1. You can add things like leverage, which makes that like steeper. Mm-hmm. You can add things like shorting, which makes the slope like negative. So when ETH goes up $1, you lose $1. But then you can have things like options, which give you more flexibility and creativity in structuring very arbitrary shapes for payoffs. And that's kind of where I guess Panoptic comes in.
Yeah.
Well, we'll get into exactly how you do it, but like it lets you create these very complicated shapes very simply. And unlike traditional options, there's no expiration date, which is where I guess the perpetual side of things.
And we lean into that. This is a perfect way of describing it. We lean into this description quite heavily. On our front end, you'll be managing these payoff curves. You'll be dragging strikes around to make it look like the way you want. And it's all going to be in terms of what your exposure is. Do you want infinite upside or do you want infinite downside, meaning you can lose like infinite money? So all of it will be very visual. You'll see it right away in a way that even if you trade options in TradFi, it's still kind of hidden and implied. But now we kind of expose it and make it much easier to understand it and trade in.
Awesome. I can't wait to use it. Okay. So you've compared like LP tokens to being very similar to options. Can you explain how that relationship works?
Yeah. And this is, again, the result of my own research, like going through the math. What's the value of an option? You can plot it on a graph. And if you look at it, it says, oh, wait, it looks like setting a put option. And then if the more you dig, the more you see. But yeah, the key point is that by providing liquidity in Uniswap in a concentrated manner, not necessarily V2 like or full range, but in a concentrated manner, it means that whether you're above the range or below the range, you kind of transform your LP position into either token A or token B. You can think of it of depositing ETH, only ETH, and then if the price goes up, this gets transferred into cash or USDC. If it goes down, you just get stuck with that ETH. So that transformation that is your LP token happens by trading activity in Uniswap. The traders push the price around, and if you're out of range, it can be 100% ETH, 100% USDC if it's on the other side. So that's kind of this unique property of LP tokens. They change composition depending on the price. And when we say it looks like an option, we can go through an exercise, but this optionality comes in by borrowing or shorting an LP token. So if we go to a scenario of buying a call option, and now we'll go back to the definition of like exercising the right, but you have some ETH that's being deposited in Uniswap. It's below the current price, so it's 100% ETH. You as a buyer, you short or you borrow that LP token. So you receive 1 ETH in your account. Now the price goes up. The ETH was sitting at 2,500. You remove 1 ETH, it's in your wallet. The price goes up, 2,500, 3,000 goes up and up. As it goes up, that LP token now is transformed into USDC. So you borrowed 1 ETH, but you have to pay back 2,500 USDC. And your debt is kind of this weird instrument that changes composition with price. But when you're ready to kind of move on or close your position, you keep the ETH for you, and then you deposit 2,500. So the price could be much higher, but you deposit 2,500. So you effectively buy 1 ETH for 2,500, regardless of the price. So that is the key of why we can build the whole kind of gamut of options in Panoptic, because LP tokens is this kind of magical instrument that changes composition with price. So you the traders don't necessarily think about swapping in terms of options, but then the LP token now is more like an option instrument because of that.
Gotcha. I think that makes sense. So I think one of the differences that I've always thought about in terms of LP tokens versus like sort of traditional options is traditional options, you sell for a premium, whereas LP tokens, it's not like a premium per se, but like you get like trading fees off of like volume. Is how can we reconcile those two differences, and like what's the right way to think about this?
Yeah,
because some people think this is a big difference. Some people think that it's less of an important difference.
So again, if we go back to the initial point, someone deposits liquidity in Uniswap. This liquidity sits in there that you sold an option. Someone can buy it later on, but if it's sold, you do get a return, which is the fees collected by the trading activity as you described. If you're in range, you collect fees. This increases over time. When you go out of range, you stop collecting, but what's being accumulated, it's yours. So you can collect, you can redeploy, you can compound if you want. But if we start from this basic idea of providing liquidity creates an option like payoff, what if we say the fees collected is going to be your options premium that you are receiving? So you have premium on one side, you hold it for 21 days, for instance, and you have the fees collected, and then we can use the regular kind of tools from finance, like Black-Scholes equation, to fit. Okay, this is my premium. This is the amount of time I've held it. What is the IV, or what is the volatility of that option? And if you do this, you can extract again an IV that gives you the expected kind of volatility of that asset. So it's implied volatility. It's not the real one. It's not the one you see on Deribit or centralized exchanges. It's just a new quantity that you can trade with. And if IV is lower than realized volatility, if implied is lower than realized, you should buy options, like roughly. If it's higher, you sort of sell options. So you can still trade and do IV plays that people call, but now you just have the fees collected is your premium. It grows over time, and you don't know how much it's going to generate over time. But if you look at the IVs, say per day, you can have some idea in the future. And that's how you can get paid by selling options. If someone buys that option from you, you take the same formula if you want. Buying an option means you remove liquidity, so you have to reimburse the fees that would have been collected. So I sold an option, someone removed it from Uniswap, but they have to pay me back that fee. So the fees collected as well is what the buyer will pay. And this price starts at zero and increases over time. And the longer they hold and the longer it's in range, the more expensive that option is going to be. But it's when it's time to kind of execute or exercise that option that they have to pay the premium, but hopefully they are in the money and they can have a net positive EV as well because of that.
Yeah, I guess that does kind of like make sense intuitively in the sense that like, you know, the closer like, you know, the spot price is to the strike price, you know, the more expensive that option is going to be to buy. And also like the closer, you know, the spot prices to like your liquidity range, you know, the more trading fees you're going to get. So there is sort of like this like correlation between trading fees and like the in an LP token and like the premium you pay in like a traditional like option.
And the key point is that in traditional finance, it's a market maker, someone that sells it to you that decides the price ultimately. There's a bid-ask spread. If there's a lot of activity, it increases, but it's still kind of, there's an intermediary that makes this calculation for you. Whereas in Panoptic and Uniswap, it's real trading activity that happens. So it's like creditably neutral. If there's a lot of trading activity, a lot of people paid fees, and this is why you have a higher return. If it's a boring asset and no one trades, you get no return. So it's very, very organic, and it's not going to be something that can be easily manipulated or taken over by, again, market makers, because it's real fees that are collected by traders.
Love it. Okay, so I think now it's time to start. We can really like dive into like how Panoptic like works under the hood. And so I was reading through their white paper, and it sounds like there's three main agents in the Panoptic protocol. There's liquidity providers, option buyers, and option sellers. So what are the role that each of these agents play, and like who's taking like what position in this market?
Yeah. So the option seller would be similar to the current LPs in Uniswap V3. They come in, they deploy liquidity, they may be a bit more sophisticated than the average user, they have a range, they kind of manage it a bit more actively, but that's kind of what a seller is. They just trust their instinct to deploy liquidity in the right range, and if it stays there for long, they get higher paycheck. This is what you have in the status quo. You deploy liquidity in Uniswap, you're selling options, you're a seller. There's a liquidity provider in Panoptic, we call them PLPs, and this is kind of bringing back passive liquidity providing to Uniswap. So these liquidity providers, they act a little bit like in a lending protocol. They deposit funds, one side, two side, regardless of which fraction they want. They deposit funds in the Panoptic pool, and these funds can now be borrowed by sellers. They can be borrowed by traders. And the key point is that this gives the ability to traders to access leverage. I described earlier, I would borrow my tokens on Euler Finance, bridge them to Uniswap, and deploy them. Here it's all happening within the Panoptic ecosystem. But because LPs deploy liquidity, they lend their funds, and they get a return if you want an interest rate from that lending activity. And the more activity there is, the higher the APY if you want. So you can still get exposed to a Uniswap pool by being a lender that capitalizes on trading activity from, again, traders in a way that is kind of impossible to do currently with Uniswap. So again, sellers provide liquidity into Uniswap. Liquidity provider deposits funds and lend them out like a lending protocol. And finally, you have buyers. These would be kind of your retail users or those that know about buying options. They would now participate, enter. Again, they still have to deposit some funds in the Panoptic pool to act as collateral, but they would look at what's been sold, what's available to be purchased. And these would be options that other sellers have sold that still end up in Uniswap. And they would, again, if they want to buy, they remove that liquidity, reimburse the seller for the amount of fees generated, and then get the exercise. So the buyer is removing liquidity from the Uniswap pool, The more liquidity you remove, the more price impact you have per trade. The more price impact, the more trading you have to kind of be in check. You increase the volatility by buying, and vice versa. If you sell, the more liquidity you put, the more it stabilizes the price. The less returns you get per unit of liquidity, that decreases the volatility. So that's kind of the back and forth that exists between buyers and sellers. They affect the Uniswap price impact, if you want. They affect the Uniswap volatility in a way that you cannot see currently. If you go currently in Uniswap and you try to provide liquidity in the ETH USDC pool, for instance, there's an oversupply of liquidity. And that means that any extra unit of liquidity will be receiving less returns than you would expect because there's too much liquidity. So as a rational trader, I should be buying these options, to be removing liquidity to make the price less stable, if you want, because the trading activity is what it is. So here we kind of open up this ability for traders, buyers and sellers to kind of trade on volatility to create a liquidity distribution that's kind of optimal in Uniswap. And you have these liquidity providers that kind of fund the whole ecosystem by providing liquidity and allowing users to tap into leverage. I think you're muted. Sorry, Kenny.
Sorry, that's a classic move. I do that at least once every podcast. So let me see if I got this correct. So we have the liquidity providers who put up capital. Let's just say it's an ETH DAI market, so they put up either ETH or DAI or both. Then we have the option sellers who look at the borrowing rates of for the both assets, and based on the borrowing rates and their sort of understanding of the markets, they decide, where to LP, what range they want to LP in. And then you have the option buyers who go and see the LP tokens that are available, and then they, I guess, borrow those LP tokens and then remove the liquidity from them.
Yeah, that is correct. The key point is that the interest rate for borrowing is actually fixed, and you pay it once when you open a position, and it's like a commission. It's 10 basis point. It corresponds to maybe a few days worth of interest rate at like 10% APY. And the key point is that we use this as a way to fund the PLPs, but it makes, again, somewhat of the calculation of interest rate easier because it's only paid once, and then it goes to the Panoptic LPs right away.
Okay, that makes sense.
As a passive liquidity provider, you should get a steady stream of revenue the more trading activity there is. The commission is paid on selling an option and buying an option. And if an option lives for one month, it's traded once. If it's traded multiple times per week, multiple times per day, you collect that kind of commission every time.
Okay, yeah, that makes sense, right? Because it's sort of like the more volume and volatility there is, the more people are gonna be like moving their LP positions, and the more money you'll make as a PLP.
Yeah.
And the more stable it is, the less money and also the less risk you're taking.
If you have stable coin pool that moves 1 bips per few days, there's not going to be a lot of back and forth needed. It's like, okay, I'm still in range, so I don't care. But yes, the more volatile the assets, again, could be Pepe. This was a crazy wild ride. I would be happy to buy options on put options on Pepe, like from what's been sold. Now it's kind of possible to do with Panoptic.
So you mentioned in the white paper that the option, I believe, sellers are kind of play an essential role for the protocol, and the protocol may benefit from providing subsidies to the sellers. Can you go into some detail about why that might be the case?
Yeah. And again, there's a pecking order as to which one is the most important. But yes, the liquidity provider plays a very similar role to the liquidity provider. The seller plays a similar role to the liquidity provider in Uniswap, meaning that you need liquidity. You need funds to be deposited, whether it's well distributed or not. You just need users to make the market liquid. And then traders can come in. If you have no liquidity, there's no trading activity. And you have like a cold start problem. As long as there's enough liquidity to attract enough trading activity, then that's right. You can increase the amount of sellers, but this is kind of the most important, crucial part. Just enough liquidity to get started so that there's enough trading that could be kind of supported by that pool.
That makes sense. Yeah, yeah. If you don't have like a critical mass of LP tokens available to for people to borrow, then nothing really works.
Yeah.
But once you have like enough, then the whole like yeah, we can get into where. But I really can't wait to get into the details of like all the
Yeah.
different stuff you can use it
At the
for.
end of the
But
day,
like
yeah,
yeah,
if you have like
I
too many degen traders that want to buy options, and again, I'm sure that we'll see a lot of users, maybe your listeners as well, but buying options is removing liquidity, increasing IV. You may hit a critical point where, as you mentioned, there's no liquidity to survive. So we have to be careful who we incentivize. That's why we put emphasis on the sellers. Buyers, of course, are important, but then too many buyers would be detrimental to the system long term.
so
I have a question just going off of your Pepe example. I know a big goal of Panoptic is to make flexible options available for DeFi users. Looking into a future where this succeeds and is highly used and there's a lot of volume, do you see the availability of these tools changing the market psychology of trading or the behavior? Because, like for a lot of people who wanted to play the Pepe market, maybe the only thing that they were able to do easily was to buy and hold, right? And say there's an easy way to have inverse exposure. Does that change the dynamic of these meme coin rallies? What do you think?
Yeah, of course. And I think that the volatility we see in the markets and the meme coins is because there's no options market to kind of like provide a different venue for trading, accessing leverage, as you say. If you cannot short an asset, of course, the only thing you can do is buy, and then the buyers will make it go up, and then they sell on top, and there's no way to profit. So you need a back and forth market. I personally trade only options in TradFi. I'm options build because of the flexibility, what it allows me to do, short, long, even neutral. You can have a strategy for that in TradFi. We want to bring the same kind of mindset to DeFi users. Of course, there needs to be swappers that buy and hold, sell and sell high, buy low. But yes, the directional plays, the leverage plays. You can be neutral. Neutral is a valid strategy. You can actually benefit from being range bound in a way that you can only do it with options and not necessarily with buy and hold. And yes, I want as many users as possible to be options build. Think of options first whenever they want to express a bearish, bullish, or neutral kind of strategy.
Yeah. Kenny, we got a question about your hair. Did you get a haircut?
I did, but I think I had a haircut as early as the last previous
Yeah, I think
podcast.
so. So,
So it's two podcasts old, but thank you for noticing. I'm flattered.
anyway, back to the math and finance.
Back to the important stuff. Uh, so I think it might be helpful to think through this. So let's say I'm an LP, a PLP. I post up some ETH for the ETH DAI pool, and then the option seller borrows that ETH and then deposits that ETH into Uniswap V3, I think right above the ETH spot price. And then the option buyer comes along and borrows that NFT position. That's a setup.
Yeah.
And so then the price of ETH goes up, like 5% or whatever it is. Who wins? Who loses? Like, how does that whole like
Yeah.
how does that scenario play out?
So maybe a big criticism of options, it seems to be a zero-sum game because you win, someone else loses, you pay someone, you get paid. I would say that in Panoptic, it's a little bit different because you have the swappers and the traders that generate this kind of external price that you can kind of latch onto. But yes, from your experience, someone provides liquidity, someone borrows this, put it above the price, someone buys it, the price goes up. So the buyer, by buying this call option, had a positive outlook on the token. Bullish, they think it's going to go up. It goes up. They win, and they win the most. They presumably paid a small percent. Like if it was 1 ETH worth of calls, they may pay 0.01 or 0.02 ETH, and they get 5% exposure. Very leveraged. Like you pay a little bit, you get upside exposure. They were right in terms of selling an option, buying an option that was direct, showing a bullish outcome and it was bullish, so they are making money. The seller, by selling that call option, actually had a bearish outcome. They expected the price to go down because as the price goes down, the payoff is negative. It's a negative delta strategy. And they maybe paid a little bit. Maybe that extra fee offset their losses a little bit. But again, they were wrong. So in that case, they would lose. Typically, this is what you see in currently Uniswap. You provide liquidity, it goes out of range, you're stuck with the asset, you lose. The key point is that they could do other strategies to kind of offset that risk. They could sell a call and sell a put at the other side to create a straddle or a strangle where it's more neutral and it enlarges their break-even point. And even though the price went up by 5%, they could still be in the green if you want. Or they could buy a call option at higher strike so that they also limit the maximum amount that they can lose. Maybe it's 10% away or maybe it's 1% away, but they could also control the risk by buying options themselves to offset like the max loss. So this is very common in options. You never see it one by one. Many options are multi-legged, put, call, up to 4 legs at the same time. This is what we can do as well in Panoptic. But the tools you need to be successful in Uniswap v3 is buying options, puts and calls. You can only sell options. That's why people are kind of worried. And it's true. It's difficult to be successful if you can only have one tool to your arsenal. You need 4 of them. Buy and sell, puts and calls. So yes, in that specific scenario, the call seller was wrong. The price went up, they lose. And the PLP, the person that funded this whole enterprise, they get 10 basis point when it was sold, 10 basis point when it was purchased. So they have 20 basis point. This maybe could be 20 basis point on one ETH, which is 0.02 in 1 day, 1 week, regardless of how long it took. But they do get a steady yield because of that. So the PLP are strictly increasing in amount. And it's like almost risk-free rate. It may be better than the staking yield, for instance, but it can only go up unless there's a humongous crash like ETH Luna or the whole thing goes down where there's going to be some losses that could be realized in terms of LPing. But yes, if you're one of the larger pools, without kind of painting a rosier picture, it's more likely you go up and up than see these kind of black swan events.
Kenny.
Once again, I did it again. Yeah, there's always these asterisks. There's always an asterisk when you're like, an LP in these like kind of pools with leverage, where it's like, yeah, look, you're only gonna make money unless.
Yes, of course.
That's just, you can never get 100% like certainty with anything.
And,
so that's just
if you want to have your ETH work for you, if you go in the ETH DAI pool or the ETH USDC or the ETH Luna or the ETH Pepe, it's still the same ETH, but it's exposed to a different risk level. And you would expect maybe the Pepe to generate more yield, but the risk of losing big by collapse is higher than ETH USDC, for instance. So staked ETH would be the lowest one. So it's all about trade-offs. We cannot guarantee everybody's gonna make money, but it's gonna be a more diverse, perhaps. So that's what I like about options. If you have a directionality, if you have a risk tolerance, if you just want to be bullish, bearish, there's a strategy for you. It allows you to express this strategy. It's very strategic in the sense that there's 10 different ways to do something, and the best way is what you think is best. Someone else may think it's something else, but at least you have the opportunity to, or the choice to do it.
I have a question for both of you, but Kenny, it looked like you were going to jump in.
I just wanted to clarify, if you're an option seller and someone buys the option from you, they pay like an interest rate like every block.
Yeah, if it's in range, the position will collect fees. And you can poke or query the Uniswap contract and said, okay, they removed half of my position. The half that was removed, how much would I have received? And this, you can use this to settle, I guess, how much they have to pay. Okay. So it's also based on Uniswap trading. If it's a volatile asset that has lots of trading, it's going to be expensive to buy at the money options in a way that if there's no trading, it's going to be cheap. So that's kind of the idea.
Okay, that makes sense. Sorry, Cairo. Go for it.
Oh no, my question, because both of you guys are building protocols where people are incentivized to provide liquidity in exchange for a return. And recently, there's been a lot of talk about liquid staked ETH, and specifically the increasingly rising percent of total ETH that is uh, liquid staked, do you potentially see a future where liquid staked ETH replaces or serves the purpose of ETH in these major trading pairs, or where it's hard to attract liquidity providers because there's the opportunity cost of not holding staked ETH? And uh, how do you
Yeah.
anticipate that going?
So in the world of options, typically for the past few years, the risk-free interest rate was zero, so we never had to worry about the interest rate. But there's a cost. There's a cost to carry now, which is non-negligible in TradFi options. Again, you deploy cash. Could you deploy it in a bond or whatever you want to call it and get a higher yield? And that comes into the pricing of that option. And yes, I think the maybe Uniswap v4 would make it a bit easier, or there's a way to kind of convert like still liquidity into staked ETH, and you can still tap into that potential of like providing liquidity and getting the risk-free rate of ETH staking. Trading is a bit more clunky to just go and get your ETH to stake ETH, and then you trade for your Pepe, and then when you sell. So I think the trader will not do it, but the protocol can now tap into like ways to make the idle liquidity or the liquidity in its kind of smart contract work for it.
Makes sense.
Yeah, I guess to me the open question is, will people want to like trade using staked ETH for like stable coins or other assets in Ethereum? Like, will people want to be, say, buying NFTs with staked ETH, or will they prefer vanilla ETH? I don't really know the answer to that, but I think as long as there's demand for trading pairs in like vanilla ETH versus staked ETH, then it'll work itself out one way or another. The market finds a way. But it'll be interesting to kind of watch, because my hunch is this, that like there's going to be like always like a slight, like staked ETH isn't risk free,
Yeah,
like there's just it we can't really beat like the native asset of ETH, because like if like if anything bad happens to native like the Ethereum blockchain, everything's screwed anyway. And so like it's hard, you can't really hedge that risk. But like there's like like this like if something happens to like those staking platforms, like that could be really bad for the whole platform as well. But it's not as existential as, like, I don't know, like the low level blockchain. So my hunch is that there's always going to be some demand, some market for native ETH. It's an open question to me, like how big that market becomes relative to staked ETH.
Interesting. Yeah, I think that one of the risks and benefits of crypto is that there's not much that's too big to fail, in that nobody's coming to bail out
you're on your
huge
own.
insolvent protocols. We
Yep.
just kind of eat the loss, which you can make an argument is healthier, but it also creates a risk that, retail may or may not be pricing in. It's hard to see the future.
Well, it does seem that these, decentralized financial platforms like are a lot more resilient to like catastrophic failure. Where like I think one of the big problems with like the 2008 global financial crisis was that like no one could really figure out like who owed who what, and so that just like sort of like compounded all the problems. Whereas in like DeFi, it's like Etherscan isn't perfect. It's not like the easiest thing in the world to like use. However, it's light years easier than trying to figure out like who owed who what mezzanine debt on some like complicated like swaption like mortgage backed security thing. Like, so it does seem to me that maybe we don't even, it's I don't, hopefully we never put this to the test, but eventually we will, that like DeFi in general doesn't need bailouts to like restart the system and come back online.
Yeah.
Yet.
Another
No, but
thing,
I'm kidding. Yeah. I can
yeah,
feel too that
Yeah,
we
thinking
know ahead of
about,
hopefully
time.
we never test this.
Yeah, we even know like okay, this position will
Yeah.
be liquidatable when the price is. So it's very very in the open. And again,
yeah,
maybe you could have anticipated the 2008 crash by having all the information the level that we have with Etherscan and Ethereum.
one, I guess you could say, defense or merit-based argument for short sellers that I've heard. Not that short selling necessarily needs to be defended. But I know, at least in traditional markets, there's an aversion sometimes, is that it creates a incentive for people to dig up not just the good news, but also potentially the dirty laundry and the problems and corruption with assets, companies, protocols, what have you, and creates a sort of healthier information market because it's not just about pumping narratives. So I wonder, in this goal of making options more prevalent and possible, will we suddenly see more money incentivizing, I guess, A, digging up dirty laundry and keeping people informed, or B, potentially misinformation narratives, uh, attempting to drive down
Yeah.
token prices?
I mean, I think
I guess I don't
yeah.
really have a question, but
No, I kind of
yeah,
feel like, again, as I said, with options, you can do what you want, whatever you want. Up, I mean, bearish,
yeah,
bullish, neutral. We provide the tools, but of course, we have to be careful about manipulation. But I would say that, yeah, the binary choice of buy and hold or don't do anything is kind of limiting. And I would say that the role of short selling, or you can call it kind of being a bit more like directional, is useful for price stabilization, and also, as you say, to kind of incentivize users to just not see the upside, but also if there's a way to profit on the downside, regardless of what happens, if it's a crappy token, there should be a way to short it. And you could do this to some extent with borrowing and even perps. But the key point is that I would not say that the it keeps the protocols maybe on the edge, as you say. It's not just good news, but yeah, bad news can hurt you. So of course you have to be putting yourself the best way forward.
yeah.
So I know we're running a little short on time. There's one question I just really wanted to get you a chance to talk about, because to me this is one of the coolest things about Panoptic and Panoptions is the ability to like really tailor make and custom a lot of different like option designs. Like I think you listed like maybe 8 different like crazy options in the white paper. I thought that was really cool. Can you talk a little bit about like how this works, and maybe even sort of like kind of give us like a teaser of like the user experience we have to look forward to.
Yeah, and again, the in the white paper, I used real strategies that exist in TradFi. I trade also myself often, like a jade lizard or an iron condor or a zebra. These are weird names, I guess, but it's all strategies that are made by composing multiple options together, and it serves a purpose. You have more upside risk, more downside protection. You can actually construct any payoff you want. And if you do it often enough, then you give it a name. Straddles, strangles is a lot of what market makers trade. And then from the buy side, you don't see as many of these kind of multi-legged strategies, but it's still something that we want to push forward. But yes, as I mentioned earlier, it's very visual. It's very like intuitive when you see the payoff. And if I show you an iron condor payoff, kind of looks like an iron condor, but you can see it right away. It has some features. It's a defined risk strategy, delta neutral, in the way that the zebra is still defined risk, but bullish. So all of those strategies help users make a better choice in terms of where to invest and how to kind of trade options. And yeah, the interface will make it so that you can preload some of these strategies and you can create a J lizard by clicking a button or a strangle or straddle. But the key point is that if you can see it, you can adjust it to exactly what you want to do, and it's going to issue it to you. So there's no limit as to what you can create as a trader, because if the interface shows you something, then it's makeable if you want. So you can make it. And we have a maybe for the podcast users, we have a it's so funny, the name. Sometimes we have one researcher that published like 18 different strategies, again from calendar to straddles, strangles, like again super bear, super bowl. We may have like a NFT Easter egg as well for some users as well. By interacting with the protocol, you can have a Jade Lizard issued to you in some NFT form. I guess keep an eye open, but it's going to be again when we launch. We're gonna launch this fall. We'll do a gated launch with trading competitions over the summer, but then we'll keep it under wraps. But yeah, there's going to be a NFT surprise maybe for the first
Cool.
users. Yeah, when we launch.
Ooh,
Alpha drop, nice.
very exciting.
That's what we're here
Yeah.
for. So I've never used like a traditional options like TradFi options trading thing.
So you
Do
haven't?
they
That's
give you the
fun.
ability to like click buttons like make
Yeah.
me a jade
No,
lizard, make me one of these,
so
make me one of those, or
most options most options platform are horrible. They don't allow you to do this. Even the actual interface, if you are unlucky enough to hit the options tab on your trading interface, Schwab or whatnot, it's horrible. It's an Excel spreadsheet worth of numbers. You don't know where to look at. You have to kind of these weird columns. They don't make it easy. At least personally, there's one platform called Tasty Trade that is made by traders, but you can preload your jade lizards, strangles, iron condors, and they are also leaning into this kind of retail focused payoff that you want type of thing, as opposed to buy puts or buy calls. Like this is also somewhat binary, but setting options, multi-legged strategies allow you to be a lot more flexible. But yes, we are lucky that we have a new way of doing options that has no expiry and no strikes, because we can move away from that horrendous UX that you have on your Schwab or Fidelity interface. We can innovate and create something that's, again, as easy, hopefully, to use as Uniswap to some extent.
oh man, I can't wait. Okay, let's see here. So I guess last week, well, yeah. So last week we had Jason Milionis on the podcast, and we did a deep dive in loss versus rebalancing, and I promised him I would ask you about it. So how does loss versus rebalancing, and for those listening who didn't catch the last podcast, loss versus rebalancing is basically like a word for, when arbitrators like buy low on a centralized exchange and then sell high on Uniswap or Curve or something like that. And basically, they're collecting arb profits. It's kind of, the idea is that these profits are coming at the expense of liquidity providers in these platforms. Although this is a fairly like contentious issue, and it's sort of like really not like, it's kind of like an unsolved like science of AMMs and market making and DeFi versus CeFi. So I wanted to get your take on loss versus rebalancing or lever, and like how you feel like it interacts with or doesn't Panoptic.
Yeah, I'm pretty vocal about it, and even today I was actually in a Twitter shouting match maybe with other users. So yes, so again, long story short, you compare LPing, which is kind of passive. You provide liquidity, you wait a day, a week, a month even, and you come back. This is like selling an option typically. You sell it many days from expiry. Typically I sell something like 40 or 50 days from expiring, and I close it like a week or two before it expires. But it's a very slow process. It takes many days. You make $100, but it took you 40 days. But this is somewhat passive. If you compare this to a extremely active strategy, which is, as you say, you rebalance your positions, you have a centralized exchange, no fees, no slippage, you can rebalance every time. And even though you start at a point, the price moves all over the place, and you come back to the same point. In Uniswap v3, when you LP, you have no loss because you get back to the same point. But had you balanced, sold, and bought the underlying assets on a centralized exchange, you would have been better. So in my view, this is comparing a passive long-term strategy to the high-frequency trading strategies that, again, you can do on centralized exchanges, but you cannot quite do on Uniswap or even on chain. So I think it's a comparison to something that's unattainable, and I would say that's why I don't like it, because it means that the retail users, the users that don't have the ability to manage their books, I guess 24/7, they see this. Oh, I could have made 10% more if I was the super efficient trading machine. Whereas you will be in the profit zone, you will have a positive return. It's a passive activity. You may do less because you don't work as much, but it's not going to be a loss per se. Same thing with impermanent loss. On loss of even the fact that there's loss in it makes it so that you start with this assumption that you either lost, which is false, or you could have made more, but this is also unattainable. So a lot of folks are attempting to solve LVR and say, once we solve this, LPs will come back because they won't lose as much. My solution is maybe perpendicular to this or orthogonal. I say, let's embrace the slow, passive nature of options and LPing. And instead of trying to rebalance it every moment, you just have a market-driven rebalance. You sell an option, someone can buy it. They both wait 2 weeks, but at least you have an exchange that's going to be driving the returns from market-driven forces and not some of these hyper-optimized trading strategies that can only be done if you have a fancy computer, 24/7 access to internet, and constant kind of rebalancing.
Yeah, and I think that's a pretty good way to look at it. It's apples versus oranges, and I think the strongest piece of evidence for your view is that like there's still billions of dollars of like liquidity.
Yeah.
Uniswap, Curve, Sushi Swap Balancer. I mean, even Shell. And
And I
so,
think it'd be great to have Guillaume and Jason on together at some point,
I mean,
and
I
we
think
wouldn't have
it's too orthogonal way, and I think most of people, even with LVR or in Panoptic, we're trying to solve like this open problem. That's why I'm so excited about it as well, myself personally. But it's two different approaches. I think the our way is better. Who knows? But yeah, I think the unlocking of options. As you said, there's billions of dollars worth of liquidity in Uniswap. It's only sold. It's people selling put options. And even if this is inefficient and very limited strategy-wise, there's still billions of dollars getting made every year. Now we allow someone to buy options, sell calls, sell puts. It's going to be kind of magnifying this like liquidity, so that more liquidity there is, the more strategies you can create. So two different ways. I'm more the retail-based user, so maybe I'm focused on what I would like to do. But yes, if I were a market maker professionally, I would say, yeah, this is easy to do. I'll do LVR and solve it.
well, a lot of people critical of LPing aren't LPs themselves, which I guess makes sense.
yeah.
But I
When
also
you
don't
say it
think
out loud,
I don't think like trying to have like a better way of, let's say, profiting from the liquidity, the passive liquidity, the liquidity that's available, in getting more of the, you think of levers like here's what arbitrage traders get. Trying to like reduce that amount. I don't think reducing that amount is necessarily mutually exclusive to using LPs as option tokens.
Yeah,
And
exactly.
I think like both of those kind of could go hand in hand. They don't have to be like I don't know. I feel like especially social media and crypto Twitter loves to. It's all about conflict. Conflicts. That's how conflict sells. That's what gets people's attention. But it doesn't necessarily have to be like a conflict. Like in my opinion, they would go really well together,
Yeah,
potentially.
and I think the Uniswap V1 and V2 was doing its job, but yeah, we can innovate as well and make it better, more efficient. But I would say that the end state is definitely not V3, maybe not even V4, Uniswap V4. It's going to be something that again attempts to solve all of these issues at once. And yeah, I agree with you more generally.
Okay, so we talked. We're a little past the hour, but I have a few more questions if you're game.
Yeah, sure.
Okay, so we talked a little bit about like the end user experience, but like, let's say I'm a developer. What can I use like Panoptic for? Like, what is there anything cool that I should pay attention to?
Yeah, and I think the thing that we don't have the throughput, I guess, ourselves is if you want to see what, say, Ribbon did or a lot of the vaults base product do, is that you could pool funds together to participate into a specific strategy. In case of Ribbon, it was covered calls, selling puts, but then you could have a delta neutral strategy. Your Jade Lizard strategy could be a vault. You could actually enhance the capital efficiency by pooling users' funds together to create something again that retail flow can participate into. So again, that could be one application of what you can do with Panoptic. Again, you can vaultize all of these strategies in a way that's very capital efficient. And also, I would say that we're using the 4626 standard to track collateral. Our options are 1155, so everything is composable. At this point, we're focused on building our own product, of course. But yeah, we try to be as open as possible. Maybe our V2 will be even more open, like the Uniswap V4 we've seen with like the hooks and stuff. But yeah, I would say that the low hanging fruit is the vaults, maybe the collaborative kind of strategies, and moving from there. Who knows?
Cool. Okay, so I got some miscellaneous questions for you, and one question we basically have to ask every guest is when token. And you don't have to answer this question if you don't want to.
No, I mean, the response I give, I guess, is there one protocol that you think has the best tokenomics around? There's always trade-offs. I'm not a fan of governance tokens. and I feel like a lot of the tokens are very securities like, very, very dangerous. So I look around and I don't see one that I want to emulate. That means we need to research this and make it again our own. And the one that I like a lot and the most is Ether. You have a burn mechanism, you have an issuance, market driven. The supply is unbounded, but it's constrained. You cannot go to infinity necessarily. You cannot go to zero. So this makes it very, very attractive as a model. You burn to use the protocol, so you cannot escape that fact. So I think most tokens should have some of that component as well, where you are not just staking or locking, but getting rid of it to gain some economic advantage. And if it's a huge advantage, you'll burn more. If it's less, you'll burn less. But yes, that's kind of already. So long story short, we don't have a token for Panoptic V1. Maybe V2, maybe later on, but we don't want to be kind of overcommitted to a specific model that we don't want to kind of carry through for the next 10 years.
I feel that. I think you're spot on.
Yep.
Okay. So last couple questions. What do you think is going to be the long-term competitive advantage of DeFi versus CeFi?
I think DeFi will eat the world. I think we're just at the beginning. We have tokens. We have maybe USDC is the largest real-world asset. You could do it with all currencies. We can see FX trading happening on chain. We could see commodities, whether your barrel of oil sits in a warehouse. If it's a piece of paper or a digital kind of ledger, it's much easier if it's a ledger. So I would say that all of the trading activity, all of the like assurances of like supply chain, NFT, everything will migrate to the blockchain the same way that, again, everything is on the internet now. And it's I mean, maybe it. Hopefully I'm not too delusional, but I think this is kind of the end state, and this is why we're doing this now. We see the end goal and not the scammers and everything else, distractions between. This is the end state. And it's like saying, how do you think mail will compete with internet? If you ask someone in the 80s, they have no idea what the internet would do, but if you have some forethought, you know where it's going to go. So I think the same thing will happen with not just, I mean, maybe it's not Ethereum, maybe it's not the same like protocols, but eventually the cryptographic assurances, the like open permissionless nature of blockchain makes it so that it's inevitable. There's no other way to do it.
Yeah, because it does seem like the DeFi blockchain, it's like much more transparent and easy to figure out what's happening, which I think is just like super useful. It's also like open and permissionless, so it's much easier to like experiment and try new things. And crucially, it's like socially scalable, right? Where you don't have to worry, like say you want to spin up your like an options market that's centralized. It's like, well, unless you have a fairly high degree of trust of Guillaume, are you really going to trust him? Or you really want to give him all your like ETH and DAI and like just hope he doesn't kind of pull an SBF and kind of, you know, have a nice little mansion in the Bahamas. Like, whereas like in DeFi, you can be like, well, I can go read through my code. Maybe not everyone's savvy enough to read through the code, but all you need is like, you know, a few dozen people that are savvy enough to read through the code, verify that it's good, and then you're off to the races. And I think, you know, between the social scalability, the permissionlessness, and like the transparency of what's happening, it just seems sort of like a recipe for a recipe for long-term success to me. I mean, and like there's no way CeFi can...
Yeah, we're talking with lawyers now. Again, we want to be careful, of course. I mean, there is the exchange, FTC, SEC. Yeah. We have to be careful. And our lawyers, of course, they know about Web3, but it's like when you dig and scratch a little bit what TradFi does, it's a mess. It's a Rube Goldberg machine of intermediaries, and you have one provider and 25 different intermediaries that kind of talk to one another. Yeah, it's because trust was difficult, because people would steal your funds left and right again over the past 100 years. So they had to do it that way. And if we try to say, no, crypto cannot do this, so we can forget about all of this, that takes some change. It's actually a huge paradigm shift. And we can say we're going to register it as entity XYZ, but it's going to be one of those intermediaries in this kind of huge mess, like spider web of components. DeFi makes it a lot more, like, again, safe, but then a lot more streamlined. Again, we will follow the rules, of course, but then there's no place for a DeFi protocol unless you're like anyways. the long term view is, I think, the simpler, more secure the protocol is, the easier it is to kind of again use it and kind of expand from there.
Completely agree. Okay. I guess the last question I got for you is how would you compare the culture in academia versus the culture in DeFi, and what can DeFi learn from academia, and what can academia maybe learn from DeFi?
I mean, I think in academia it's a different world. The feedback loop is very, very slow. You go to a couple of conferences every year, you see the same people, they worked on the same thing that they were working on 6 months ago, and then there's a few updates. I would say it's still collaborative. You still are eager to kind of talk to your peers, but yeah, it's a very slow, like deliberate way, and sometimes it doesn't work for reasons you don't understand. Sometimes it works well, but it's a little bit less like in your control. The same way that again, DeFi. Yeah, I like the pace. I like the innovation. I like that you can code it and make it work the way you want. You don't have to worry about your bacteria or your organism doing X, Y, Z. It's like very, very deliberate. I would say that yeah. What can DeFi learn from academia? I think there's yeah. It's a bit difficult. I think in academia it's very, very open, collaborative. The it's like we're working towards a larger goal, and everybody gets that to some extent. In DeFi, it's always like maybe short term, like can I outcompete everyone else? It's like business more or less. But I feel like in academia, you have like this like easiness of like interaction and collaboration that is kind of natural because this is what you do, and we know again, someone solves cancer, even if you don't find the cure first, you're extremely happy regardless of the result. So that's kind of the mindset that everyone's in, whether it's a very, very small and niche project or scientific kind of topic or a big one. It's all very collaborative. So that should be a bit more involved. Again, Vitalik, the everyone that is in the Ethereum kind of ecosystem signaled a lot of it, and that's why again the community it is what it is. So again, I would not say that this is not what's done, but maybe at the app layer is maybe where we have to kind of get along a bit better, I'd say, and not trash LVR as much. No, I'm kidding.
Yeah. I know. I'll admit I can be guilty of a little of this competitive
I mean,
ego get in the way of
yeah, there's some ego.
sort of
There's
celebrating.
yeah, in academia it's also
Just
healthy overall. But yeah,
win.
you're not competing for like funds. If you get scooped, yes, you feel bad for an afternoon. Someone else published the result before you, but it's not the end of the world. Here, it's like life or that. So yeah, I can imagine that not everyone can kind of just simply hold hands and get along. But yeah, so that would be my view. But yeah, overall. Mm-hmm.
That's a great perspective. Cairo, any questions you want to ask before we wrap things up?
No, we had one more audience question, which I'll pass along out of gratitude to our audience for tuning in, which is, Guillaume, in the short term, are you bullish or bearish on crypto prices?
Prices? Yeah.
You don't have to answer.
Yeah, and I think the as an option trader, if I want to be kind of directional, I can do it. I'm mostly neutral. I'm wrong more often than not. If you think you're neutral and it goes up, it's not too bad. If it goes down, it's not too bad. If you think you're going to be bullish, you think it's going to go up and you're wrong, then you lose doubly, I guess. My view is always neutral to bearish, neutral to bullish, but very, very constrained. And it's like small, like short term, a month, maybe in the future. So my default question now, 10 years from now, will always be I'm neutral in the short term. Everything else nobody knows. And again, that's the power of options. You have to internalize that you don't know. Not just you, but no one knows where the price is going to go. Even if you have the SEC doing something, it's priced in. It's random. One day is going to go up, the other day is going to go down. There's no way to know. And once you start with this, you can open up new doors as opposed to say, wait, I don't know anything? What does that mean? Now you can trade on something else. You can trade on volatility, you can trade on volume, you can trade neutral in outcome. Yes, maybe my best outlook is that nobody knows, don't know, your neighbors don't know, your boss doesn't know, no one knows. But that's good. That means that now you can kind of go above that and trade on something else.
Well, that's it for me. It was a real pleasure having you on. I'm glad that we were able to make this work. It's we were trying to figure out how we got connected, Kenny, and I think the Panoptic team reached out to us, is what we figured out. So
I thought Eliza bumped into
that's what I
Guillaume.
thought too.
That
Um,
was
Maybe. Uh,
well, it may remain a mystery,
of
but
course. Yes.
uh, Eliza, if you're watching and it was you, thank you. And regardless, really glad we could connect. I personally am gonna go check out Panoptic as soon as I'm able
Yes.
to use it.
I forgot to. I'll plug it. Plug it again. Yeah. Call to action. We're gonna do a gated launch starting next month. There's gonna be a trading competition on the layer two. We'll have limited amount of users, and we'll have a sign up sheet that will kind of go out this week or maybe early next week. It's gonna be hardcore. 64 users will rank best to worst, but boot the bottom half and re-onboard new users. So if you want to trade, you will have to kind of be successful. Maybe doing nothing is the most successful thing you'll do. So be careful. But yes, we'll open it up and hopefully we'll keep this going every week. We'll reset, do it for like a few months, and then hopefully people will get a taste of Panoptic.
Wow, that's intense. I've never heard of that one
So
in crypto.
yeah, it's gonna
I'm
be
curious
weekly
to see how it
options.
goes.
Weekly options, short timed. Could be 0 DT. It could be weekly, but yes,
Yeah,
that's gonna be the and it's gonna help us also figure out how to deploy, how to manage, and around the kinks in the interface as well. But yeah, so yeah, be on the lookout.
cool.
Follow
Well,
our
what's
Twitter account, and myself as well retweet. But yeah, that this is where you'll get the alpha.
and once that's up and running, we'll have to have you back and hear about
Yeah,
how it's
I mean we'll
going and
do.
what you've learned.
Our scientists will use that content to generate analysis. Who won? Who lost? What were the strategies? Drive the content, I guess, in the narrative out of that real world experiment, I guess, from traders.
I
Cool.
love it. Nothing like putting your ideas into reality and seeing what happens. That's my background is in economics, and that's why I left sort of like standard economics. Is like, how do you test your
Of course.
ideas? You can't, which is why there's a lot of pseudoscience in econ. But in DeFi, well, guess what? Just build your options protocol, put it out there, and see what the heck happens. You don't have to
Yeah.
have like this endless theoretical debate. Just look at
Yeah,
what
exactly.
happens. So it's like,
I'm an experimental physicist as well. I have to be in the lab. I have to do it and see. There's no amount of
Yeah.
equations that can convince me. So yeah, of course. Yeah, this was awesome.
Well,
Yeah, thanks very
a
much,
pleasure.
guys.
And we'll talk to you down the line, I'm sure, and we're gonna stay. Kenny, you ready to do our little community update?
sure, yeah.
Okay. Cool.
Thank you so
All
much,
right,
Well,
Guillaume.
thanks
thanks,
a lot,
thanks, you
man. Thanks
guys.
for coming on.
Yeah.
Pleasure.
All right, bye.
Ah, Elisa says she chased them down at the Cornell thing. I
That's
remember
what we
when you
thought.
went to
Yeah.
that. Look at that, bearing fruit. Uh, community update starting. Oh, sorry guys, I'm a little congested. I getting over a cold from last week, but I'm hanging in there.
So yeah, how are you doing, Cairo?
I'm good. Yeah, sort of planning out our next season of events. Um, oh, Alpha Drop, I guess. I was talking with Ishan, and obviously Stargate and Reuni were our winners from the pool party, but all, or at least the majority of the tokens that were in the finals, had a very positive reaction. So, um, Ishan's thinking was that it doesn't need to be, last man standing. We can really add as many tokens as there's going to be community support for. So, in the medium term, we'll probably be adding additional token support from the finalists there.
Cool. That'll be
Yeah,
awesome.
and it's really great to be at a point where like Proteus and the ocean have been proven out enough that it's not like a nail biting decision to launch a pool, where it's like, is the code gonna work? It's more of just like a practical affair, you know. Feels good. I think that the end state there is to get to the point where anyone can do that, uh, and we don't even need to be in the loop.
I
Yeah,
mean, we're getting there. Yeah, we've been working on UI UX for people deploying their own pools. Still very early days. It's not going to be live anytime soon, but it's in the pipeline.
yeah.
And
Our line for like over a year was that we're front end constrained, and I think we're no longer front end constrained. So
almost, yeah,
that
almost.
feels good.
We've been
We're
doing a
getting
lot of
there.
good work with the design team in Poland.
Oh yeah, the winners will be added first, Kim. Don't worry. I have not seen anything like this Reuni fan base slash cult. There's a lot of passion there. I'm very impressed. I
Well,
think we should
welcome to the
take some
Shell
notes.
ecosystem, Reuni. We are excited to have you on board.
Yeah, we were trying to figure out parameters for the pool, and it's probably just going to be constant product because you have so much beautiful upside that we could not possibly write a concentrated curve that would capture your potential. So,
Wow, Cairo, I envy your fiance. You must write the best love letters.
um, you know, I do write words sometimes. Kenny, how are you?
I'm doing well. I got a haircut, as someone noticed. Thank you. Um,
Yeah.
and yeah, just the summer is officially starting, which which in Hawaii, being like a white dude in Hawaii means, you gotta like pay more attention to like sun exposure because it gets like mega strong right around now. But paradise problems. I shouldn't
Yeah.
don't. I want it's not like I'm complaining. Uh,
With
yeah,
the peak exposure is like what, like 11 a.m. to 3:30 or something like that.
yeah, like 11 a.m. to like 1:30 probably is like when it really is like super intense. I
That's
think
a good
like
time to get some work done anyway.
yeah, 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 yeah. Uh, anytime like yeah, after like 3:30, like I find I don't really get too sunburned after 3:30. In fact, that's kind of like the optimal like tanning hour for me. Um,
Yeah.
but yeah, just I'm getting kind of so. Should we talk about like dynamic multipliers
Oh
that
yeah.
we're
Fuck yeah,
working
let's
on?
do it. So not very different than crypto people in Dubai. Yeah, I'm sure they also get sunburned. Um, Dynamic multipliers. So people have been asking for utility for toucans for various and obvious reasons. And I think that this is an appropriate and fair thing to ask. Toucans have a very special place in the shell community. And, when you have a fun asset slash collectible, like a toucan, you want to be able to do things with it. And one thing I think that we can do that is achieving that goal and also like authentic to our mission and not forced is to allow toucans to be the early vanguard in tests and experiments as far as how the protocol functions. They were the first NFT in the NFT AMM, and that went very well. And so now they will also be the first in a way for this new thing we're trying, uh, dynamic multipliers. And there are a few ways to explain it. Kenny, I guess I'll let you pick the best way to dive into this.
Yeah. Well, I guess the basic idea is we've, based on our own experience setting these multipliers and seeing what happens, and also feedback from a couple of our LPs. Um, it seems like there might be a better way of structuring like the how shell points get calculated. So right now we've been using a dollar day framework for basically every dollar you leave in the platform for 24 hours, you get 1 shell point. Is how it's been working. And I think the problem is we want to be able to, as a protocol, be able to fine tune like how much liquidity or TVL is allocated to different assets. And
Currently,
it's
we do that
also,
with multipliers, but it's not a fine instrument. It's kind of a blunt instrument. We can sort of try and price in risk or incentives with those multipliers, but it's very uh yeah.
or like an example would be like TwoCoin, where when TwoCoin pumps, you get a lot more shell points, and so therefore the incentive to hold TwoCoin goes up. But when TwoCoin crashes, you get a lot less shell points, and the incentive to like hold TwoCoin goes down. And
Yeah.
so we think it might make more sense to, I guess, use a model that's more similar to traditional like LP incentives, where we allocate a certain tranche of certain amount of shell points every day goes to this asset, regardless of like how many people are holding that asset. So for TwoCoin, the way it would work is, let's say, I'll use simple numbers here. This won't be the actual numbers, but let's say we'll have 100 TwoCoin or 100 shell points per day will go to TwoCoin holders pro rata. So if there's 100 TwoCoin and you're holding 10 TwoCoin yourself, you would get 10 shell points every day from holding that TwoCoin. And so what this means is, like, if people sort of exit and aren't holding TwoCoin, let's say the supply goes from 100 down to like 20, and you're still holding 10, that means now you're going to earn 50 shell points a day. And so this has more of a stabilizing effect, and we can also kind of more
Yeah.
fine tune like how many shell points get distributed to like which tokens and which assets.
And you can think of it this way, because TwoCoin is where we're going to start, but say you apply the same model to an LP token, the amount of those LP tokens in existence, it reflects the amount of liquidity in the pool, because the more people LP, the more of those tokens get minted. And so this essentially, as Kenny said, provides a stabilizing effect where the lower the liquidity gets in a certain pool, you have the same amount of shell points total allocated to that pool going out to fewer LP tokens because fewer exist, which means the rewards per dollar day in effect become more concentrated. And that, by the way, we're going to stick to the multiplier framework as far as how this is presented in the UI. I think people understand it. I think it's a pretty elegant solution, and we will provide the math under the hood, probably first just in a blog post, but we may find a way to show that in the UI if people really want to know. But essentially, like, say, um, for TwoCoin, there is the amount of TwoCoin in existence is such that in effect, for every dollar of TwoCoin you hold, you're getting 2.5 shell points per day, right? That's because that's how much TwoCoin supply there is. What you will see on the front end is you will see a dynamic multiplier of 2.5x, which is still reflected in dollar days. The difference is just how this is being calculated. And if more TwoCoin comes into existence, that will in effect go down because it's being spread across more tokens. If TwoCoin goes away, because people are minting toucans from it, um, it will become more concentrated and it will in effect go up. So yeah, it will hopefully mean that even if you are not enough of a power user that you want to start doing all the algebra, you can look at the interface, look at the current dynamic multiplier, and make an optimal decision for yourself based on your risk tolerance and your preferences, and your price predictions based on the current dynamic multiplier. That is our hope.
And we're gonna roll this. We're gonna experiment with this new model on TwoCoin first, and maybe wrap toucans. I don't know. Well, TBD, but definitely like TwoCoin is probably what we're the most focused on right now. And you know, usually whenever we try something new, there's some kinks that need to be worked through. Hopefully we will have anticipate all the major ones and it'll be fairly straightforward. But just in case, we're just gonna only do TwoCoin, and then maybe we'll expand it out to like wrap toucans and the TwoCoin ETH pool. And if that phase goes well, then we'll probably roll it out to the entire protocol, and I think that'll be like really cool. And another like kind of nice benefit of this is that we it makes it a lot easier for us to predict how many shell points will be issued in total. There'll be some, there's questions of like how do like boosters factor into this, so it's not like completely deterministic how many shell points will be
Yeah.
created, but it makes it a lot easier to anticipate. Which I think down the road, especially once we have a liquid token with price discovery, this could open up some cool mechanics for how we incentivize liquidity and also how we determine like allocations of shell points in the future.
One big goal for me after the TGE is to essentially use the established price of shell tokens to convey some sort of estimated APY, similar to more traditional liquidity mining interface. So if we can set up shell points and seasons in such a way that this is fairly predictable, um, I will be happy, and I think users will be happy. And people who uh, are not shell aficionados, but simply scour DeFi like locusts looking for the highest percent APY, will potentially find shell and be able to quickly figure out whether they want to participate, which should be good for all of us. Thinking about these dynamic multipliers, Kenny, I think one thing we will have to decide is whether they are appropriate for simply wrapped fungible tokens, such as Sheath and things like that. Because,
Yeah,
yeah,
I think so because we care about having wrap tokens too, don't we? So I don't see why not.
yeah, I guess just in setting like a base supply as far as the multiplier, we're almost like setting a target, which is appropriate when you have something like an LP token that needs a certain amount of liquidity. But when you apply a dynamic multiplier to like Sheath, you're essentially saying like we need X amount of Sheath in the pool in the ocean, and the lower it gets, the more we'll incentivize it, And why? I guess like why? Why
Well,
not?
yeah, why not? I feel like it's a good gateway into getting people to. It's a pretty low risk way of getting exposure to Shell protocol and getting to know it.
Yeah,
And that's a good. I mean, it's a good point. Maybe we won't. Maybe we will. Maybe
yeah,
we
we
won't.
could leave them static. I mean, we'll have to see. Uh, but yeah, that's dynamic multipliers. I think we pretty much just explained the whole thing. So,
Yeah,
uh,
we're still building it. We're not gonna give you like a date or a timeline of when it'll be ready, but hopefully it won't take too long. It's not like a huge shift.
we're also working on, well, I'm not doing anything, but Kevin is working hard on tweaks to the shell point calculation algorithm, which hopefully will lead to shell points showing up more quickly when you open your point screen, which will be cool.
Yeah, that's
It
kind of a
does
big.
load for a few seconds currently.
Yeah, that's definitely like a big priority for us in terms of like shell point UX is just reducing that latency. Because that's one of my big pain points every time I have to use the app. I'm like, fuck. Just
Oh,
want
and
that
another
token hit. Now I gotta wait
feature
5 minutes.
I'm very excited for because I recently had to send 2 coin to a bunch of people for this contest on Galaxy. My brain keeps wanting to call it like Galaxy, Galaxe, Galaxy, but I assume it's Galaxy. I don't know. Anyway, whatever it is, I had to send some 2 coin, and I realized it's kind of a pain in the ass because you have to use the safe transfer from contract creator on RBScan to send it. And so we're adding a transfer button, which already exists for LP tokens, but we will be rolling it out for 2coin and for other Ocean assets as well.
Yup.
Yep.
Is there anything else to go over Shell community wise?
I feel like those are all the things that are immediate. We are going to be doing another item-based event, but not for a little while. We're also working on bootstrapping pools for NFTs and tokens, which we mentioned in a previous podcast. That also is a little bit away, but we're developing it. And I think as Kenny went into before, this will hopefully be a more elegant way to sell, say, crates or something like that, and have better price discovery instead of just guessing a price and then letting it sell out, in a very quick period, which is not really fair to people in certain time zones, and for a few reasons, it's not ideal.
I think, yeah. Also, I think just in general, I imagine there's a lot of people out there that have these sort of video game type item 1155 tokens or NFTs that they would like to, sell to raise some money and make sure that it's fair to their community, and also like they get to, get some capital out of it. So if you know anyone or any projects looking to sell a large tranche of ERC 721s or even better 1155 tokens, hit us up because
If
we're that's
if I all of a sudden was not part of the Shell team and I found myself as a person who wanted to create an NFT collection, and this Shell NFT bootstrapping technology was available today, the way that we anticipate it being, I would use it honestly, because it just makes sense. It makes sense, and I think it would be a good experience. We're going to try and make it a good UI UX for everybody, um, and yeah, hopefully others feel that way too when it does come out.
cool.
Cool.
Well,
Well, I guess that's about it. It's another successful podcast, another interesting guest. We get such intelligent and charming, engaging guests on this show. Um,
okay, wait. I'm looking at the Mindmeld chat. First of all, Sanchez05, if you're listening, thank you for noticing my haircut. Um, I know it's my hair is not as long and luscious as it was, but I think it's a little cleaner. Makes me look younger, I think. Which when you get into my age, I won't tell you how old I am, but when you get to my age, you want to look as young as you can because you know father time is irrepressible. Let's see here. Kim9, when tokenomics part three? Oh, I was hoping people would forget about that. Um, I gotta write it up. I think the main bottleneck is I really want to make sure that um I don't know if we'll go into details about this in tokenomics part three, but long story short, launching it if you're a US based team whose company is building one of these open source sort of DAO protocols, like writing the software for that protocol, how that DAO and protocol launches a token in a way without getting us like in legal trouble is not that clear. I think I think we have like a good idea of like we can how Shell can generate a token without, putting the Cowrie Labs team at like legal risk. And before I write out tokenomics part 3, I just want to make extra sure that so the rest of the context is like more or less like 99% figured out. So that way, because if let's say it's 90% figured out, and then turns out that like, oh, that extra 10% that we didn't figure out makes this token vesting scheme a lot harder to pull off. We need to make changes to it. I want to make sure that that doesn't happen. And so, um,
Yeah, we really hate overpromising, especially when people are making financial decisions based on the information we put out.
yeah, but I guess so I don't want to put it in writing as like an official blog post, but I can like talk through like kind of like the high level idea of the design. Um, and basically like everyone, the people working at Cowrie Labs, the investors in Cowrie Labs, and crab holders, i.e., the community, uh, we're all going to be subject to the same vesting lockup criteria. And the idea is there will be like a 2-year linear vesting period. So every block, a little bit of tokens unlocks, and that goes on for 2 years. Um, that way, we kind of prevent like a dumping of the tokens right off the bat. There will also be a V token model, sort of similar to Curve. So you lock up your shell points, and the longer you lock up your shell tokens, and the longer they're locked, the higher your voting power. And some people maybe don't want to wait for their shell tokens to fully vest, and so what they can do is they'll have the option to exercise this early, and but they'll pay like a penalty for that. We don't know what that penalty is. We're still thinking about it, but there'll be there'll be some penalty of exercising your tokens early, and the penalty that will go either to the Shell DAO or potentially that'll go directly to the V token holders. So basically, what you have is a system where the people that vest slowly and lock those tokens up into the DAO will benefit from the people that vest early and give those tokens back to the DAO. And so if you want to vest early, you totally can, but there's going to be incentives not to do that, and there's going to be incentives to lock up your tokens. And I think again, don't hold me to the details until like the blog post is written, but that's kind of what the strategy is right now. And I think to me the most important thing is to make sure that like everyone, regardless of whether whether you're me, whether you're Cairo, whether you're Kim9, whether you're Blue Yard, the seed investor in Calorie Labs, we're all more or less playing by the same rules. There's some like caveats and exceptions, but those are kind of, I don't know, too hard to really explain and go into, especially until those details are like fully sussed out. But that's like high level where we think we're going to end up. But again, this could completely change in the short term. Probably won't change, but stay tuned for the blog post to get the full picture and the full details that are more or less crystallized.
Yeah, Kenny said we're not doing part 3 soon, then he basically just did part 3 right here. So, uh,
Well, it's not like the information. I don't want to keep the information like secret. I just don't want to
yeah,
put something in writing, then have to like backtrack on it because that's just
I
not only is it a bad look, but it's a kind of a communications debacle.
I
So,
think that one great thing about this medium is that we can impart the appropriate either emphasis or caution.
context.
Yeah, context. I thought of one thing that I wanted to pose to the community before we go, and it is on the subject of NFT bootstrapping. And something that we have found in our preliminary market research on NFT collections and the way that they mint. Currently, uh, these NFT collections, there are certain norms associated with the way that they mint. And these norms are helpful for people who have limited attention or just degens or just want to feel comfortable aping into something such as, a fixed amount, etc., colors, styles, whatever. And one of these things is the idea of a whitelist, which, in other contexts, people are, more saying allow list, but as far as I can tell, with NFTs, whitelist is still the prevailing term, or just WL. And it's this idea that there's a mint date for NFTs, at which point a fixed number will be sold at a fixed price. And if you have access to the whitelist, you are able to mint early, which means you essentially are at less of a risk of the mint running out before you get a chance to get yours. Um, and this is something that is used as an enticement or a reward for people. Because these collections, before they do their mint, they will hand out whitelist spots, um, or use them as promos, etc. They give these things out. Um, and I won't get into the psychology or the marketing of this, except in that how it relates to this bootstrapping, because all of a sudden, if you do have NFT bootstrapping, you're essentially running a Dutch auction uh, for your NFT collection, where the price starts very, very high, and as the liquidity pool for the NFT evolves, the price lowers until it reaches a point where all of the inventory has been sold at whatever price the market decides to value it at. And the thing about that is that there's really no longer a point to having whitelist access when you have a Dutch auction, because getting in early essentially just the NFT is more expensive. And Kenny, jump in if I'm misconstruing anything here. But in our talking to NFT projects, this is something that we've found at least a couple times is they go, okay, well, how do we reward our whitelist users if we are doing a Dutch auction for the NFT? And this is an open question. One of the initial thoughts we had was, okay, well, maybe instead of getting in early, the whitelist users get to buy at a discount, So say like the Dutch auction starts at 100 ETH or 100 Doge or whatever you want to call it. Whitelist users pay 90% of that. And then the whole way down on the Dutch auction, they're just paying a 90% or 95%, 10%, whatever discount you want. That might not be the best way to do it, though. So I pose this to you, community. If you think that there is a good way to integrate the concept of whitelists with the concept of a Dutch auction NFT bootstrapping pool, let us know, because this is something that we'll have to figure out.
Yeah, I wonder if there's got to be a way.
There's got to be a way. There's always a way. Um, so yeah,
Well,
all right.
thanks for tuning in, guys.
Yeah, let's get back to work, huh? Um, Everyone, thank you for being here. Thank you for watching on replay, and we'll see you around. Aloha.
Bye, everyone.